Hello viewers, students and friends. This is Dr. Kashinath Neharkar, Assistant Professor Sri Shivaji Law College Parbhani, and I welcome you in my YouTube channel Law Education Volunteer Dr. Kashinath Neharkar. Friends, in last lecture we have discussed the history of Income Tax Act. Now in this lecture we are going to discuss some basic concepts under Income Tax Act, because while discussing various provisions in next lectures, we may need to use some important concepts. We must know such concepts. But before that, friends, please subscribe this channel and press bell icon to receive further notifications. So let's start to discuss the concepts. Friends, first concept we are going to discuss is what is Finance Act. Friends, the Income Tax Act is amended every year by the Finance Act, that is presented in a budget session and passed in that budget session. But we must understand what is the concept of Finance Act. Friends, every year the Finance Minister of Government of India presents a budget to Parliament. And friends, budget is nothing but the proposal. Budget is nothing but a proposal. It is the proposed idea how rupee will come and it will be expended, how the expenses of that rupee will be made. So how rupee will come and how rupee will go. So this is the proposal. It is the proposed scheme. So the budget is presented by Finance Minister of Government of India, and that budget have two parts. Part first of that budget speech contains proposed policies of government in fiscal areas. That may include what shall be the policies, what shall be the taxing slabs, what shall be the taxing rates, what income will be included, what the exemptions will be given, what deductions shall be given, what encouragement schemes shall be given, what incentives shall be given. All these schemes are provided. How government will raise revenue through the Income Tax Act and through other taxes. So the Income Tax Act is also the part of such budget policy, Finance Act. And a second part of the such budget speech contains the detailed tax proposal, including income tax, GST, or what the other taxes also. So this is the proposed scheme. Then in order to implement such proposals, the finance bill is introduced by finance minister in parliament. Firstly, it is introduced in Lok Sabha, as the finance bill cannot be introduced in Rajya Sabha. So, once the bill is approved by the parliament, it means Lok Sabha, Rajya Sabha, and the President of India. Then it gets assent from the President of India and it becomes the Finance Act. So, what the finance bill that is approved by the parliament, that is called as a Finance Act. And then such Finance Act, that bill is formed into the act that is called as a Finance Act. And then we must see what are the effects of Finance Act. So that Finance Act renews, amends earlier enactments relating to tax, including income tax, policies relating to taxes, policies relating to schemes, etc. Then it introduces new policies, schemes, tax rates, exemptions, etc. So in short, it amends all those laws which are related to finance, including taxation. So every year the Finance Act is passed and accordingly the amendments are brought into the income tax, etc. So this is the first basic concept you must know. Friends, now we are going to discuss second concept, and second concept is person. Friends, as you know, The income tax is levied on income of person. Income tax is levied on income of person in the previous year. So we must understand who is that person. So section 2 clause 31 of Income Tax Act, it tries to define the concept of person, and according to the definition, the income tax is charged in respect of total income of previous year of every person. Here the person means the list of such person. Friends, the this definition is inclusive definition, and it provides the list of persons that are liable to pay tax. So it includes individual, then Hindu undivided family. Individual means the natural persons, and then some of artificial persons like Hindu undivided family. This is also the person who is liable to pay tax. Then the association of persons, body of individuals, it can be called as all those registered persons or unregistered person. Then it includes company, those companies which are registered under Companies Act, then firms that are registered under Partnership Act, then local authorities if they get the income, then every artificial juridical person or juristic person which is not included in above list. So the friends, these are the persons who are liable to pay tax. So the definition is necessary by which a person shall not try to escape from the liability of payment of tax. So the income tax is levied on a total income of previous year of every person. Afterwards we are going to discuss what is the concept of previous year, assessment year, etc. Then Fred, second, another important concept we must know is assessee. Who is called as assessee? General rule is that assessee means the person who is liable to pay tax under the act. Such person is called as assessee. But we must see what is the definition of assessee that is provided by section 2 clause 7 of that act. Firstly, you must understand what is general meaning of assessee. Assessee means the person who is liable to pay tax as per the provisions of act. But here the definition provides, the act provides the definition. Income Tax Act 1961 defines assessee means the person by whom any tax or any other sum of money is payable under the act, and it includes every person in respect of whom any proceeding under the act has been taken for the assessment of his income or income of any other person in respect of his assessable, or the loss sustained by him or such other person, or the amount of refund due to him or such other person. So friends, this definition includes the assessee who is deemed to be assessee as per the provisions of act. So the person, according to this definition, the person who is liable to pay tax under the act, he is called as assessee, or the person against whom any assessment proceedings are commenced under the act, he is also called as assessee. That assessment proceeding may be commenced to determine his tax liability, to determine his income, or to determine whether that person has claimed correct refund, whether that person has availed correct deductions, etc., or whether, if in case that person found escaping or evading the tax liability, what shall be the punishment to be given to him. For all these aspects, if any assessment proceedings is commenced under against that person is called as assessee. So that include deemed assessee also. Deemed assessee means in certain circumstances the person may not be actually owner of that income, but that person is made liable to pay tax for that income. So such are the circumstances where that person is called as deemed assessee. So such this is the definition of assessee. Then friends, you must know another important concept, and that is the previous year. So What is the concept of previous year? As you know, the income tax is levied on total income of assessee which is received in a previous year. Therefore, you must know 2 years. When is the previous year? Firstly, we will discuss what the definition, then we will compare what is previous year and assessment year. Firstly, see, as per this definition, the year in which income is earned is known as a previous year. So the previous year is the financial year immediately preceding the assessment year. So all assessees are required to follow the financial year. As per you know, the financial year generally commences from 1st of April and it ends with the March of next year. So this is called as a financial year. But this financial year can be either previous year or this financial year can be either assessment year. We must understand. So this uniform previous year has to be followed for the taxation of income from all sources. Now we must understand what is the assessment year. This is also defined by section 2 clause 9 of the act, assessment year. So according to this definition, assessment year means the period which starts from 1st April and ends with the 31st March of next year. So the income of previous year of assessee is taxed during the next following year, that is also called as assessment year, and that will be assessed at the rates prescribed for that particular previous year. So friends, many of student gets confused by these two concepts, when a year becomes previous year, when year becomes assessment year. Friends, as you know, the tax which is earned in a previous year, that will be taxed in a assessment year. This concept must be clear. For example, this is the current month is April and this financial year is 2020-2021. This current year is 2020-2021. So this is the assessment year. And now we want to see how 2019-20 is a previous year, because for example, Dr. Kashinath Neharkar, he was employee somewhere during 2020 19 to 20 in the previous year. So what the income I have earned during last year 2019 to 2020. So during this period my income will be computed and I have to fulfill my tax liability, payment of tax liability before 31st July of 2020. So here the period which was started by 1st April 2019 and which end at 31st March 2020, this period is called as a previous year, and the income which is earned during that period shall be taxed before the end of 31st July 2020. So in this period, the period of 1st April 2019 to 31st March 2020, this is previous year, and the assessment year is 1st April 2020 to next 31st March 2021. This is the assessment year. If you have any doubt, you can call me or you can email me. So friends, these are very important concepts under Income Tax Act. If you like this video, please share it with your friends. Thank you friends.